Hey guys, welcome to the Beyond the Rate podcast.
Yes.
We are getting into the middle of this, and we've been talking about kind of what we've been listening to. So we're just going
Right.
to jump right into it. Okay,
Yes. Yes.
this is what I think is going to happen. They're going to keep kicking the can down the road as long as they can.
And hold on. Off of our Don't Listen to 2023 Predictions podcast. Now we are making our 2024 predictions.
Yes.
So,
Sorry.
Take what we're saying either with a grain of salt, or we'll come back a year from now and see if we were right.
Yeah.
All right.
So
Go, Will. What do you think is going to happen?
I'm ready to get into it. Okay. They're going to keep kicking this can down the road as long as they can, but they're going to realize that they're not going to be able to do it any longer because they can't afford it. Our debt is too high. And when we're spending more in debt annually, when I say we, I mean the government,
Right.
than we are on all the other programs that we need, including defense spending.
Yeah.
And the economy is looking like it's about to break. They're going to have to start cutting, and they're going to start cutting probably pretty big. Now, up until this point, I haven't thought that the cuts are going to be that big, but I could see them having to do some major cuts either, mid to late this year, but they're going to try to push it off past the election. That's what I think.
Right. In an election year, they said there was almost no change in mortgage rates during an election year. Like, if they went up or down, it was by such a insignificant margin that it was basically the rates didn't move at all. Right.
Yeah.
So I think I agree that I think they are gonna kick the can down the road. Here's the battle I think that's gonna happen is, man, you're right. I think,
there are a lot of things that are up at play, a lot of variables,
and they conflict with each other.
Yeah.
So we can't have, here's what they're trying to avoid. Okay. Now, this is what they're trying to avoid. This is inflation rates versus mortgage versus federal funds rate. Going back to 1971, we had inflation spike in the early 70s. So then the federal funds rate, the mint green line, they spiked the federal funds rate to get out ahead, I think, too, also because they knew inflation was happening because of the Saudi Arabian oil embargo and massive increase in gasoline costs and stuff. Mm-hmm. So they raised the federal funds rate, inflation went up, inflation started coming back down, and they were like, okay, we're going to lower the funds rate as well because we think we got inflation under control. And what happened? Like, inflation spiked again. So that's what I think that they're scared of right now is we had inflation spike. And as you can see at the end of the chart, just 2 years ago, inflation spiked. They raised the federal funds rate to temper inflation. Inflation has been trending downward, but I think that they're scared to lower the federal funds rate because they want to make sure inflation is coming down. They don't ever want a repeat of the 70s and, okay, we're going to lower the federal funds rate. We think we got inflation under control. And then that spikes again. They don't want inflation to spike again. So that might be why they said March is not the time we're going to lower the funds rate because they don't feel like inflation's under control yet. But on the other side, you're right. There's all of these government bonds coming due, and at
commercial real estate market, multifamily, all these buildings that are having to refi.
Right. But also too, the feds, the almost 0%, 0.5%, 1% treasury bonds that they were on, and now over the last couple of years, they're paying 3%, 4%, 5% rates on treasury bonds, government debt, the government and now they're having to pay that debt. Mm-hmm. And so all these 0.5%, 1% rates are falling off the books. And now they're having to pay 3% annual returns, 4% annual returns to these investors buying government bonds. So you're right. government debts, interest paid by the government is skyrocketing.
Mm-hmm.
So you're going to have this battle between the government saying, "Hey, Fed, hey, lower those rates, please." you know, lower the funds rates. We want those, and we want yields on everything to come down. But
Who do
also,
they
too,
care?
the Fed worried that if they lower their federal funds rate, then inflation might start trending back upwards again.
Who do they care about more?
They care more about the
Or
government.
what do they care about more? Their ability to continue spending all the money they want,
Yeah.
or the American taxpayers' inflation? The American
The
taxpayer having less
which
buying
one?
power because because inflation has gone up. Which
Wh-
one does the government care about more? They
Oh,
care about themselves more.
the government cares more about them being able to
Themselves.
spend.
Yeah, being
Yeah.
able to spend. Yeah.
Yeah. Yeah.
So to me, the inflation rate is almost like it's a secondary priority for them.
Right. And the government is okay with it because they see they think these GDP numbers are amazing.
Mhm.
But all GDP is the amount that the economy is spending. And since everything costs minimum 15% more than what it did in 2020, it just means that yeah, we're spending a lot more than we did, but it's on all the basic necessities that we have to get anyway.
Yeah.
So it's not good GDP growth, you know.
Yeah.
It's and a lot of that GDP is government spending also. So it's going to be and that's why for 2024 my gut is telling me that we're going to, if rates trend downwards, it's going to be trending downwards a little bit and maybe not a massive amount, you know. Might get a little better, but not, we were at our peak in October, just 3
Yeah.
months ago. So everything is still trending downwards to correct off of that peak. Now, do we get, I don't know. It's tough to say, like, but you're dead on the conflicting interests,
Yeah.
moving into this year. So, and the Federal Reserve governors, I think, are more impartial, but Chairman Powell is looking at getting renominated, and he knows that Trump will not renominate him.
Exactly. Yeah. Yeah. Yeah.
100% he is out of a job if Trump wins.
Yeah.
So he wants Biden to win. So
So
he needs
how
to,
do they make it look good
right. How do we
while
make Biden look
still
good while also
making
not wrecking everything too?
while still making, yeah, how do they do all this together all at the same time to get Biden, or
Yep.
so that they get their
Right.
contract renewed?
Yes. So that is what we're looking for in 2024.
Yeah.
And so what I'm kind of thinking, yes. So this is the 6% conventional mortgage coupon.
Mhm.
And for everybody watching, the higher that this is priced, the lower rates go. So we want this line to trend upwards, right? But this is only going back a year. So we're still, a year ago, we were still lower rates than we are right now. And so my feeling, the last time that the Federal Reserve raised rates was in July, and then we saw, right around here, and then we saw the mortgage rates go up, bonds go down, mortgage rates go up all through the fall. I think that the market was forecasting even worse news continuing to move forward, right?
Yeah.
And as things started to stabilize, the market's like, okay, we were a little overzealous with how bad we thought everything was continuing to get. Okay, cool. And so I think right now we're in this correction phase of getting back to maybe early spring of last year, or into spring, kind of right around this time last year, Marchish, something like that, where maybe this is where the things are going to be for a little bit, right? So
Yeah.
I'm thinking right now rates, if I'm going to call it, I'm going to say rates will move downwards by a half a point.
I was going to say 2 quarter point reductions.
Right. I'm going to say mortgage rates. In general.
Oh,
I'm
okay.
not talking about. I'm not talking about
Yeah.
federal funds rate. I'm talking about, and the federal funds rate. I think you're right. I think you're dead on. I think they're going to lower it a little bit, and then towards the end of the year, realize they've got to
Slash them.
they got to slash them because there's
Yeah.
other factors at play. It's not about mortgages or inflation. It's other forces that are going to make them
Exactly.
slash that federal
And
funds rate.
they're not going to want to do that before the election, because then it's going to bring up a ton of questions on, hey, what's going on? Why are we slashing, the federal funds rate when
Mhm.
we've worked so hard to control inflation? If we just slash them again, then inflation is going to go up. So
Right.
this is what I think they're going to do: 2 quarter point reductions, May and August, and just celebrate that we've achieved the soft landing. And then what day is the election?
Like
November 4th, November
November.
5th.
Yeah.
You add on 2-3 weeks, however long it takes for some of those counties to count the electronic votes, overnight at 3:14 a.m. However long the computers take, apparently, to
Right.
upload
If
huge
they they have to
tranches of
whatever water
votes.
leaks need to be fixed,
Yeah,
at the polling
exactly.
stations, right?
Yep.
Yeah.
So give it 2 weeks. November 20th, whatever meeting is the first meeting after the election is, like, finalized,
Right.
that's when I'm predicting
All right.
hey, we've got to cut by a half a point, 3/4 of a point, and then the month after that, they do it again.
Okay. So
So
we're putting you on record. Oh,
put
no
it
way,
in the
dude.
record.
Okay. So the Federal Reserve meetings for 2024, there's one November 6th and 7th. So literally the day after the elections. So that's going to be a hold, is what you're saying.
Well, unless it's already
Unless
defined.
it's already decided, like
Yeah,
it's been called.
yeah,
So you're thinking it'll be either there or December 17th, 18th. One of those two, they're going to just federal funds rate, slash it.
yep,
Interesting. Interesting. Yeah. Because they've kicked the can down the road long enough and they dug themselves such a humongous hole.
yeah.
Mm,
Unless that's not when, like, okay, let's say Trump wins.
yeah.
Maybe it won't happen until January 22nd or something, until the
Mm,
meeting after Trump is sworn in,
yeah.
because Powell's going to be out and somebody else will be in doing
Just
what he should have done a long time ago.
right.
And
Right.
if Biden wins, then I would assume that it would happen immediately, because he would still be, yeah, it would happen immediately. So
Right. Right.
I think we get at least a full point over the 2
Mm,
meetings after the election.
like immediate half point, half point.
Yeah.
Right. Right. Because,
So I
yeah.
think I think the refi boom actually starts happening January 25.
Yeah. Well, and that's the thing. Hopefully you know what? And that
If
could
that, I
be,
mean,
if all that
sorry, go ahead.
happens too, because that would also mean that you're thinking that we're both kind of thinking the same, and that the federal funds rate is going to stay high enough, long enough to hopefully see inflation trending, continue trending downwards all the way through this year, which would continue the slight mortgage rate trend downwards.
Yeah,
And
a little bit
right,
down.
correct.
But
And
okay,
then
but you said you expect a half a point
a
about.
half point reduction in mortgage rates based on like Freddie Mac, their surveys and stuff. But I do think it's going to be more gradual and slower than a lot of people are anticipating. I think a lot of people are much more optimistic on the rate environment or the future for rates than what I'm thinking, just because of all the outside forces that are going to be at play, you know.
Yeah.
So, yeah, we are on the record. Yes. We've
And
gone beyond the rate.
there we go.
Yeah.
So,
Mhm.
okay, so this is how I see the housing market play out
Okay.
is we're going to still be in this same kind of environment. I think basically where it's lower transactions through this year. Yeah, I mean it'll probably pick up some because people will probably get antsy and
Mhm.
maybe a lot of people, especially towards the end of the year, that were saying, "Oh, we're gonna rent
Mhm.
another year and wait for rates to come down." They may get
Right.
antsy because they're seeing the appreciation that they did not take advantage of,
Right.
right? And so, maybe
Like people are
transaction
like, you know what?
volume,
I'm done waiting. Let's
yeah,
just go ahead and do this thing.
yeah,
Yeah.
transaction volume maybe ticks up a little bit, but it's not where it should be, right? In a
Mhm.
normal or a good environment. And then I could see, January early 25 is when we get some really nice help with the rates and volume starts to go up, and obviously that brings in a lot of people into the market,
Right. Right.
and
Yeah.
then we got prices that kind of go through the roof, not through the roof, but
Mhm.
prices that go up a
Right.
nice appreciation percentage.
Right. Yeah. Especially where we are. So,
Yeah.
um, yeah, it does feel like what I'm feeling is I'm thinking as well, you
So
know.
okay, what would the 10-year do if something like that happens where the federal funds rate, gets slashed a whole point maybe in
Mhm.
December?
Mhm.
How is the 10-year going to react to maybe the possibility of something like that happening? Would they already be reacting October, November? I guess
Oh,
how do you think the 10-year treasury moves before, during, and after something like that?
I mean, the 10-year is still the 10-year treasury yield, all the treasury yields are still moving more with inflation, the rate of inflation than the federal funds rate as well. So, like that yield, the 10-year and the mortgage rate, the average mortgage rate are in parallel to each other very closely.
Mhm.
So, and they're reacting to the rate of inflation more than what the federal funds rate is. So, I think that I think that the and so if rates are trending downwards, it's because of what we are thinking is that they're going to keep the federal funds rate higher for longer, sucking money out of the economy and
Mhm.
reducing the monetary supply, and so hopefully inflation keeps coming down. Like the rate of inflation is under, they want it to be 2%. That's their goal. I want it to be less. You
Yeah.
know, I want it to be under 2. I'd like it to be like 0.75 because
Well,
we're
we probably need several years of that to
we need
kinda
several years of
even out.
insanely low inflation because
Yeah.
nobody's lowering their prices now, you know? Like like I mean the bag of coffee that we buy, the standard community coffee in 2020 was $6 and now it's
Mhm.
7.87, I think. And I get it from the same exact place in the exact same store every time.
And that's what, 1 year?
No, no, from 2020 to
Oh, okay.
now,
Yeah.
right? So and it's like a 15% increase.
See, that's not that bad. I mean,
Not
when you
that bad.
consider, like,
It's
eggs.
still yeah,
Yeah, I know, but, like, that percentage increase over 3 years, 3 and
yeah,
a half years,
yeah,
that's not like a lot of products. A lot of products are
or even
50%
more.
increase.
Right, right.
So,
So, yeah, but so yeah, so that's the thing, like, but none of these products are gonna lower their prices. Now that their prices are that high, they're all gonna keep their prices that high. What we
mhm,
need is the prices to stay the same and for the economy to get kickstarted again, not people with 2 jobs and not the the jobs numbers being inflated with government jobs, right? All the manufacturing data is down, so we need the manufacturing sector to get jump started again, and then and then wages increase and catch back up to where the cost of goods and services is, right? So
Mhm.
that's what we need, because we have inflation. The monetary supply is out there now. Now we need, and wages are coming up, but we need them to keep rising to catch up to that,
Yeah.
So that's kind of what I feel like we need. But I think you're right. If the federal funds rate stays high throughout this year, they make sure that inflation is coming down and staying low, then we're going to get to where we want to be in terms of mortgage rates, I think. So, and the bottom for mortgage rates might be 6%.
Yeah. Yeah, if
You
it's
know,
yeah, I mean, kind of
it
what
might
we're
be
talking about.
5.75. It's not going
Yeah.
to be 3 or 4. Like, it's not, those are not, unless the Fed is like quantitative easing again,
Mhm.
massive quantitative easing, and we're going to keep buying government debt again. We're going to start it again. We're, instead of offloading government debt, all these treasuries we bought, we're going to buy them again. Unless the Fed does that, then we're not going to get down to, you know. So yeah,
For
so
if you're a
rosy, so,
prospective buyer, so
so
for a
optimistic.
yeah, for
Yeah.
a prospective buyer, so here would be an ideal situation for them.
Hmm.
They buy a house
Right.
prior to, any significant reduction in mortgage rates
Right.
because of the increased demand with a reduced mortgage rate, right? So
Right.
if the rates are able to get down to the mid fives instead of the mid sixes like we are
Mm.
now, then
Right.
every percentage point that it goes down increases, a few million
Your
people
budget.
into, yeah, exactly.
Oh, increase the amount of people hopping back
Yeah.
into the market.
Yeah,
Right.
exactly. And so obviously that increases potential sales price.
Right.
So the ideal situation is for a buyer to find the house that they love
Hmm.
or want for right now, buy it, and then be able to refi in the next 12, 18, 24 months because, let's be real, it may not happen in 6 months,
Right.
but 12
Right.
months probably at the earliest. I mean, that's kind of what I'm guessing, 12 to 18 months, right?
Mm.
And then you can refi, a point or a point and a half lower
Right.
if we get there, right?
Right. Right.
And when you refi that, the house is hopefully
Hmm.
appreciated,
Hmm.
you know, 2, 3, 4, 5% in value.
Right. Right. And
So
here's what I
that's
think
the ideal situation.
that's the ideal situation. And here's what I think is going to happen on home values too. I feel like, especially with the last 6 months being very
Mhm.
quiet as far as buyer demand, and overall, transactions, right? Overall home sales. That tells me that we're going to have a pretty flat. Like, we might not have any appreciation. We might the When we get our county tax evaluations, right? Or the property tax evaluations, we get those in April or May. They might, they should be, honestly, they should be the same.
Mhm.
Should be the same value as they were as when we got that last year. So
Yeah.
I feel like we're going to see property values flatten for right now, especially, I mean, in our markets, San Antonio,
Mhm.
Houston, Texas, strong, historically strong markets, right? Not strong, but historically consistent markets, right?
Yeah.
So I think it's going to be flat, but once things do ramp up again, like, historically, right, it's 5% appreciation per year in Texas, right? That's the average. Or you said over the last 20 years, it's been that,
Yeah,
right?
it's
Yeah.
yeah, I mean, I think for the most part, you use 3%, and if you're talking about, like, nationwide,
Yeah. Right. Right. So I
Texas,
think
I think it's safe to
what'll
use 4 or
happen.
5%.
Gotcha. Yeah. So I think what'll happen then is, like, if you buy a house now, number one, you're most likely, there's a very, very good chance that the seller's paying for your closing costs. So you're saving 5, 6, maybe up to $10,000 out of your pocket there. So there's
Yep.
really good savings there. But then also too, your value might stay flat, and then once the market picks up again, if it's 2 years even, then I think that you may not have 5% appreciation per year, but you might have 10% appreciation real quick.
Yeah.
So you might It'll probably stay flat, and then once it turns into a seller's market again, it'll jump, it'll spike.